So guys, it's 6:30, and I don't know who all we might expect, given that this is totally optional. But let's go ahead and begin to look at items that you might be interested in looking at, see if I can help you with some of the problems. Let me start by saying, Jason, thank you for having identified that inconsistency in the description on the homework quiz. Obviously, I had updated everything but the part that you were going to read. So
that's all right.
Sorry about that.
No. It's only painful for a moment.
Thank you. Well, if it helps at all, when I realize something like that's happened, I go back in and adjust the scoring. You may have seen that on the quiz already submitted. Because had you had the right input values, you would have had the right output, right? So I've already taken care of that for you and Casey. You're the only two that appear to have been having gone into that particular assignment at that point. So you caught it before other people have to experience it. So thank you.
Yep.
So Jason, let's go ahead and start with you, since I think you might have been the first on here. Ian, if you were, I apologize. I'm not trying to trivialize your participation.
No worries. Could we quickly start, I guess, on identifying which spreadsheet we're going to look at so that I can be there and follow along?
You say which spreadsheet we're going to look at?
Which assignment, Rick?
Which assignment are we going to focus
on?
Got it.
So I think, and the items that I brought up, Ian, are the homework assignment, which is not the practice homework, but the homework. So that quiz in Canvas. Mm-hmm. I have a spreadsheet for that. You don't necessarily have the same one, but you might have created one. We're going to look at at least I'm prepared to look at the problem set, the forecasting value DCF KVD, which is the Farm Hill group, and I have both that problem and solution set up, and you've got both of those, but I also have a spreadsheet for it. You may have created one, but I don't know if you have. And I don't post the spreadsheets. I just post the solution sets for that. And so I've got those up, and so we will be addressing those. But somebody else may ask another question from something else, and so I'll bring those up as needed. So, Jason.
Yes, sir.
What would you like to know about?
I'm trying to remember I think a lot of that trial and error, I figured it out. Well,
that's fine. So I'm going to kind of rotate through you.
Yeah, don't go on me.
We'll circle back around and see who's got what. So Ian, are you yet prepared with a question, or would you like me to move to Heather and then circle back around for you?
Yeah, circle to Heather and then come back.
Okay, very good.
I'm just on here because I haven't had a chance to even start anything yet, so I was just on here.
Okay.
I told you during the week I don't have time to start my assignment, so I was like, I'm just taking advantage of any help that may have been coming from this.
So I had a work session with about 30 business owners through Goldman Sachs a few hours ago, and this particular group happens to be focused on firms that are here in the Salt Lake Valley or in the Intermountain States rather, and it was not a work session, but it was a discussion group. And the intent was for them to have been looking at some valuation metrics with their firm as we're trying to prepare them for some public offerings, debt financing, and such. And there were about 30 people, and each one of whom was certain that somebody else would have questions. And not a one of them had anything that they specifically needed to know. So it made for a less interesting conversation than we might have otherwise had. But nonetheless, we all thought that was fun. We call that a collective action problem, by the way, when everybody else is ready for anybody else to kind of lead them through. So with that, Stevie, I'm going to come to you, and then G, I'm going to come to you. And G, you might not be on a phone as well, so I brought the chat up. So if you want to type something in, I'm able to see it. So Stevie, is there anything in particular you're looking for this evening?
There isn't. I'm in the same spot as Heather.
I love you guys.
I do have something now. If you
Oh, thank goodness.
Jason has a lot.
Thank goodness. G, are you in a situation where we can actually hear you tonight, or are you going to have to type into us? Well, I'm guessing that means he has to type into us. So Jason, tag.
He just said, I just want to hear some questions from other guys.
Oh, I see it there now. Okay, good. Perfect. Thank you. So all of us are in the same boat. Well, this could be interesting.
This could be.
Jason, take us along.
I'm going to ask about the homework for the one that you made the adjustments on. So
right.
as I read through it, and I looking at the revenue forecast ratio, I put together 10% based on the verbiage, but in there because industry analysts see longer-term revenue growth in this space to run at no less than 8, and then the addition, opportunity, innovative products and project, another 2%. So turns out though, in the start of that, I don't want to give too much, it comes out to 8.6%. Am I looking at it correctly?
Yeah, so what I'm doing right now is I'm going to that same material. And just to make sure I'm looking at what you're looking at. Which paragraph is that? Oh, that's in the next to the last paragraph, right?
Yes. 1, 2, 3, fourth paragraph.
Okay. I have in here somewhere another piece of information, I believe, that was intended to lead you there.
Because when you do pull up the quiz, it pops up the actual, you provide the actual forecast.
Oh, good. I do. Okay.
Yes. If that wasn't there, I mean, I kind of along the lines of the Farm Hill problem where we put a few of those together to get the revenue.
Okay. So I knew I had it here somewhere for you, but I couldn't remember where it was. So let me answer the question from a different perspective, maybe, Jason. And that is, you used 10%. I used 8.6%. Somebody else might have used 11%. I literally had someone on this one time use 25%. And are those plausible growth rates? And I would say, well, I think they are, maybe not the 25%. That might be a little aggressive. But those are plausible given the information that we have available to us. But admittedly, they're interpretive, right? Which is why in this header, when you actually open the questions, I actually give you the rate. Because if you're simply left to interpret the rate, there's no way we're all going to come up with the right answers for the quiz itself. But yeah, so 10% would have been plausible. When we think about the growth rates, there's some interpretation that goes on here. And you're going to find that if you are actually looking at a project or valuing a company or trying to run these kind of analytics for a project inside of a company, yours or somebody else's, then the growth rate or the expected increase in revenues as a result of the project or the investment is always somewhat interpretive, right? Because it's a guess. And all you can do is make your best educated guess. Well, in this case, absent me having told you 8.6%, your best educated guesses would probably be running somewhere between 8 and 12 or 13%, which is a plausible range.
Okay.
Does that answer your question?
Yes.
Cool.
So the information provided, I could have theoretically 10% would have been.
Yeah, so if this was a problem set, or if this was even worse still, like an exam, and you weren't given a specific number here, or it wasn't constrained more, you could have said 10%, and you would have been well within the range of plausibility. In fact, were this an exam, and in the course in which I do exams on this material, and that's an undergraduate course, when I grade those exams, I put into my models the information that is incontrovertible, if you will, and then I put in as variables those pieces that the students may have to gain by interpretation, and in which case the outcomes are going to change based upon the student's interpretation. But that's fine. That works. And as long as what they got fits within that range, we're good to go.
Okay. I guess I had the same kind of question for beta, because the original value, Casey helped me through that kind of reverse engineering that, but I just looked at Oracle, for the like Silicon to get a average beta.
And are you doing this from within this problem set or from where?
Yes. So the directions were like a 12%. Well, your firm has no established beta. You expect the firm's market volatility to be 12%. So I took an average of 4 and then times it by 1.
Well, let me help here, because when we're talking about beta, we have to think, what does beta represent? Well, the beta factor, as I explained it when we're doing the CAPM equation and the various inputs for CAPM, and that's the CAPM structure to find RE, right? When we're using that, a beta of 1 would represent the average return in the industry. So if you have a company that's got a beta of 1, that means their expected rate of return on common equity is equal to the average in the industry. If they have a beta that's 12% less than the average, I think we would interpret that as a beta of 0.88. So 1 minus 12%. So in this case, I don't think the 4 was a good number to begin with, and you went about it a little bit differently. In fact, I think you maybe overthought it a little bit. Remember that the industry average is a beta of 1, and a beta higher than 1 is higher than the average, risk and volatility. Lower is less than.
Okay, so I didn't have to look up Cisco's beta and then add it to, that's what I did.
Okay.
But 1, that makes more sense. Okay.
Cool, love it.
Thank you.
Rick, did you say that on the practice homework that the 35% tax rate should be 26%?
I don't know that I said that about the practice homework. I said it about the homework.
So on the regular homework, it is 35% then.
Yeah, and I believe that I have now changed that. Yeah, I've updated the text. If you look at homework number 4, the very last part of the text I have there just above the Leland manufacturing sheet is tax rate on EBIT and taxable income are both 26%, whereas it was saying 35 before I edited it earlier today.
Okay. No, I was just on the practice homework, so I wanted to make sure that one wasn't supposed to change.
Yeah, let me look at the practice homework real quick for a second, Heather, to make sure I don't have a similar issue. Okay. Yes, I have a similar issue.
So it should be 26%?
Uh-huh.
Okay, that's what
let me look real quickly to confirm that for you. Because one of the things that's coming up for me right now is I'm wondering why I'm not seeing differences between the practice and the regular homework, and that's a concern. So stay with me, please. So what differentiates the practice homework and the regular homework, if you will, is the way in which questions are posed to you. It's all operating off of the same data and on the same company, same year, same everything. And yes, it should be a 26% tax rate, so I'm going to change that momentarily. But know that there's a reason when you go to the regular homework, it looks exactly like the practice homework because it is the practice homework, but I'm asking you questions from a slightly different perspective in an attempt to help you be able to kind of ferret out what's being asked for. And here.
Thank you.
Certainly. Let me save this real quick. All right. Hey, Kang, how are we doing? So, Kang, do you have any particular questions you'd like to pose to us as we've got a little bit of time this evening?
Not in particular. I'm just jumping into
Okay.
the practice homework now.
Well, Kang, we are 6 for 6 then, because each one of you came to the exact same party. So let me spend a minute just kind of thinking about something with you. Which of you have actually started the homework quiz itself? Not the practice, okay, so you have, Jason, and the rest have not. Okay, so let's spend a couple of minutes reading through that homework text so that I can help you understand this variable means this, that variable means that, okay? That's a little easier to do when you're looking at the income statement and the balance sheet, right? It's clearer cut. But when I'm giving it to you in the middle of text, it's sometimes harder. So I'm going to bring that up. I'm going to share the screen here, and I'm going to bring that up for a minute. So stay with me if you would. And what I'm bringing up, of course, is the homework assignment itself. So let's just kind of run through this. So, and I'm not going to read word for word here, but we're coming along. We've got Leland Manufacturing. The firm's been consistently profitable, long-term contracts, enjoys strong banking relationships. In fact, at the end of 2019, and notice that would be synonymous with the end of the base year. That's the year that we are looking at this. Let me make this bigger so you can certainly see these. So the end of the 2019 is the end of the base year, so that means now. It refinanced some of its debt, and it got some debt financing of $84 million in book value. Well, if it was $84 million in book value and it just happened, what would be the market value?
The book value?
Yeah, $84 million. If it's just happening now, there's not been enough time for interest rates necessarily to change in the market, so the market value and the book value would be the same. We go on, 100% of the stocks held by its founders and some other people in 2009, so 10 years before. It offered some shares out to some other investors based on an enterprise value of $100 million. And an EBIT of $7 million. So that should be able to give you a sense of a historical EBIT multiple. So it was based on a valuation of $100 million. That's enterprise value. The EBIT was $7 million. So we got 100 divided by 7. And so it was a 14.286 multiple. So that's worth paying attention to. You've identified some other firms in the market. They're currently trading at an average of 32 times earnings. So the common stock is trading at 32 times earnings for some other firms. Well, earnings and EBIT are different. So when we think about stock trading for earnings, this is a price to earnings multiple, and this would be the earnings per share available to the common shareholders. So let's go to a spreadsheet really quickly and make sure that we understand what that is. So we've got here earnings per share, okay? And that would be the earnings. So 32 times that, so 32 times 2.175 would suggest a stock price of 69.6, where this company's got a stock price of 54.42. Well, that might mean a lot of things. It might mean that this stock is currently undervalued, or the last time it had a valuation was undervalued. Or it might mean that this company's common stock has some different characteristics than the common stock of those companies that were the comparables in the market for common. And so what could be different? Well, it could be in a slightly different industry. So let's go back and read the description. So this is two somewhat similar firms. So they're not going to be exactly. But neither of the firms has the track record that Leland enjoys, nor do they have the manufacturing contracts, but they're both publicly traded and they have limited debt. So we might generalize and say that 32 times earnings gives us a bit of a benchmark for where the common stock should trade. But don't confuse that 32 times earnings on the common stock. Don't confuse that with a EBIT multiple, because we're talking about the common stock when we look at this kind of an earnings multiple of, in this case, 32. Whereas when we look at an EBIT multiple, we're looking at the entire enterprise value. And remember that the enterprise value is the market cap of the common plus the market cap of the preferred plus the market cap of the debt minus cash. So these are multiples that are leading to two uniquely different outcomes. So do not confuse or conflate them. And I would say that, yeah, we can generalize, saying that maybe the company's common stock should be in the range of, but we do have some differences that maybe we have to think about. So we've also observed, at the bottom of the second paragraph, we've also observed a transaction in which a contract manufacturer in healthcare, well, Leland is a contract manufacturer. It's not in healthcare necessarily only, is it? Let me see. Remind me where it's at. I'm looking for the description.
Silicon Valley.
Yeah, so Silicon Valley, yeah, so privately held contract manufacturing. We don't know that this is unique to healthcare. In fact, frankly, Silicon Valley is going to have healthcare tech and it's going to have non-healthcare tech. But it gives us another comp that is kind of in the same ballpark, perhaps, right? So in this case, that other company that we've identified was valued at 127 million. Based on an EBIT ratio or an EBIT multiple ratio of 39.5. Well, that's pretty rich, right? I mean, we looked at this ratio a few minutes ago, 100 million to an EBIT of 7 back in 2009. That was a 14.286 ratio. Here we found a more recent comp for a somewhat similar company that was at a 39.5 ratio. My gosh. That would have given us much more than $100 million valuation. But maybe there's some reasons for it. In 2009, we were just coming out of a steep recession. Whereas today, we've had tremendous, well, maybe not today. As of a month or two ago, we've had tremendous growth in the interim. As of today, less so, right? But there's a reason some of these ratios might have changed because industry outlooks have changed, macroeconomic conditions have changed. Any questions about how I'm interpreting any of this so far? Okay, well, I'm going to go on. So since the last time the firm offered equity shares to investors, it's not taken on any additional long-term debt, but it did renegotiate it at the end of 2018 based on a 20-year interest loan. You got a little bit of detail there, 6% semi-annual payments, transaction funded, date, current yield on similar debt. Well, okay, so now we are seeing a difference. So, so this is interesting. We've got something here that tells us there could be a difference. We've got a 6% interest-only loan, semi-annual payments, but we could find the company could get similar debt, 4.78. So this is different than the bonds. So we've refinanced the bonds, but did we pick up anything else? Let's go to the income statement, or rather the financial statements, and see what it tells us. Well, it tells us that we don't have any of that debt anymore. We've just got $84 million in bonds. So it's conceivable that some of this information is no longer useful to us, because it did renegotiate some debt, but since it more recently did something as well. More recently, it took on $84 million in bonds, and the only debt on the balance sheet now are those bonds. So this kind of updates the information we have here in the first part of paragraph 3. We note that here's where we move on to your treasury notes at 2.45%. So what variable that we might use would we think of for that 2.45%? Any ideas?
Or-
Go ahead.
hold on, I can't think of what it's called right now.
So a treasury note, would that be a risky instrument or not?
No,
No.
not risky.
Yeah, so maybe risk-free?
Risk-free, yeah.
Yep, risk-free rate. So this is going to be RF in the CAPM equation to find RE, okay? And you have a clue to that because it's followed up by industry risk premium and a notation with beta. Well, we already talked about beta. But what do I mean by industry risk premium? So let me pick up the CAPM equation in a document real quickly, because I think it'll be helpful for you. Okay, so hopefully you can see in the middle of my screen, you can see the CAPM equation for RE. And remember that it's RF, or 0.0245 in this case, plus beta, which is 0.88, plus or times RM minus RF. And RM is the average return for shares in this industry segment. Well, this parenthetic statement, you might remember from our earlier conversations, that is the industry risk premium. So I've just told you that this number is, I believe it was 9.55%. Well, if 9.55 is equal to RF, or rather is equal to RM minus RF, if we know what RF is, then we can find what RM is, can't we?
Yes.
Okay, so that's important to think about. Okay, and we already identified the beta must be 0.88. Okay, as we go along, we say enjoys competitive advantage, innovation, overhead doors. I'm in the wrong one, excuse me. I all of a sudden went to a different case. It was starting to get confusing, I apologize. So the domestic market for contract manufacturers, 5% growth. It's a recognized leader, may reasonably expect to capture more than that. Further, you see great opportunity, innovative products and projects, maybe another 2%. And then we say that the firm, the year over year, and expects expense increases to lag those of revenue by 3%. So I'm going to read that whole sentence, and you tell me what you think you do with it. Further, you see great opportunity for the firm to expand into new markets with its innovative products and projects as much as another 2% to the firm's revenues. So we've got 5 and 2, maybe more. So at least 7% of growth. Jason says 10. I said 8.6. Somebody else is going to say something else still. But we then say, and we expect expense increases to lag those of revenue by 3%. Can you think of where or how you might use that piece of information?
Would you use that in the adjustments?
Bless your heart. Who said that?
I did, King.
King, it's exactly what you would do. So I would think that we're looking at a expense adjustment in our operating expense categories to be 3%. Good for you. Good for you. By the way, most students miss that, or they don't know what to do with it, and so they ignore it. Okay, which is not a winning strategy. So then we got industry analysts see long-term revenue growth in this space to run at no less than 8%. Well, we got to talk about the nature of industry analysts for a minute. When an industry analyst tells you they see something at a long-run growth of 8%, do you suppose long-run to an analyst on Wall Street, remember Wall Street at best measures time by calendar quarters, but more often measures time in nanoseconds of transaction speed? Do you think long-term means perpetuity? No. Heather's shaking her head. In fact, Kang, since you came off mute for just a second there, I'm going to let you come off again. So is it plausible for a company in this industry, it's tech manufacturing, to have a perpetual growth rate of 8%?
Is it? I would say, based on what you just said, yes.
Okay. And I would say that you might be able to argue for it. So let's play that game for a moment. I think you're off of mute as well, Ian, is that right?
Yes.
Cool. Okay, so would you agree with Kang? Would you agree that a long run or a perpetual growth rate of 8% is plausible for a firm in today's markets?
In today's market?
Well, let's say modern markets. Today's
Okay.
markets, I haven't looked at the Dow. I'm only hoping one still exists. Okay.
Right.
Yeah.
I would say yes, it is possible.
Okay, so let's talk about that for a moment. Here's a problem. Perpetuity is a long old time, right?
Mm-hmm.
So if a company, let's say Google in its early stages, which was posting in some years back-to-back increases of 60 and 80 and over 100% of revenue growth, right? But we know that Google settled down from that. I don't know what the revenue growth is in recent years, but it's probably still double digit in some years. So still pretty impressive. Google's kind of still the top of that particular heap. But Google, unless they maintain an Uber level of innovation forever, Google will not maintain that, right?
Right.
So would we think that the extraordinary results, year-over-year growth results that Google's had for the last 20 years, let's say, do we think if we apply them to forever, to which there is no end, would they be able to average 8%?
No.
No.
Yeah, mathematically no. Because that whole perpetuity thing is a problem for us, right? In fact, they're going to average probably 2 to 3%, which is long run economic growth expectations in commodified industries and is coincident with targets for inflation. Okay, so when an industry analyst says 8%, I don't think you ignore that. And by the way, it's part of why I said 8.6, maybe part of why Jason said 10, but I don't think we can accept that as long run in the way that we think about long run, because to us, long run is forever. So I think you still have to settle this down somewhere between 2 and 3%, and you just got to be realistic about it. Okay, as is the case with many firms, you anticipate the firm's invested capital and debt components to change as a function of expected revenues. What piece of information does that give you that has been important to us? Well, what I'm thinking about is, I'm trying to pull up my, where is it? What I'm thinking about is, excuse me, I'm trying to pull something up that I can't see. Oh, there it is. What I'm thinking about here at the moment then is constant returns to scale. What's one of the conditions of constant returns to scale? The capital components that make up invested capital are growing at the same rate as revenue. So once we identify an ROIC, then we know that ROIC is going to be constant absent any adjustments. Okay? So this has told us we have constant returns to scale. Then as we go into the final paragraph, in efforts to value the firm's equity shares, got a PE ratio, 22. Well, that might be important to us. Preferred shares valued at 10 times the trailing 12 months preferred dividends paid. Maybe that's going to have some value. And then we've got this deal about the tax rates. So now, as you go into the actual questions, the only other piece of information you need to think about is I've given you 8.6% growth, giving you an explicit period of 5 years, so 2020 to 2024, which means the first year of the continuation period is going to be 2025. And I've told you 2.5% thereafter, so that means that we're going to be at 2.5% growth once we hit 2025. And then we've got a constant debt in IC, revenue IC based on 2019. That's a reiteration of constant returns to scale. And then I tell you, you can assume expenses are driven by forecast ratios without other adjustments. So even though you might reasonably expect that 3% adjustment to be in play, to answer these questions, ignore the 3% adjustment. Okay? Is that at all helpful to go through and understand some of my thinking and interpretation on some of the input values?
Yes.
Yes, very helpful.
Yes.
Cool. I know they're the things you sometimes tend to struggle on, and I'm trying to move us from the jot and tittles that we started with of express ratios and such from the income statement and balance sheet to interpretive elements, right? So, but I wanted to, since you guys are on this call, I thought I would go ahead and give you the benefit of my thinking.
Thank you.
For
Sorry
sure.
I wasn't more prepared. I wish that I had more time during the week to tackle this.
Well,
Yeah.
it's quite all right. I will go ahead, guys, and open up another session on Sunday night. Now, it'll be the
Okay.
last one I do. I won't do one the following Sunday, even though you'll still have 1 or 2 assignments that are due. But I will go ahead and open up one on Sunday night. And you guys are typically a little bit more prepared there. Anything else you might like to ask with respect to this?
So,
No, I think we'll have more specific questions on Sunday as we kind of
Sure,
get through this.
I've got a quick question.
sure.
And if we're looking at this information sheet with the instructions, right? You've got the spreadsheet at the bottom here. With these spreadsheets, are we supposed to duplicate these spreadsheets?
Good
Yeah.
question. Well, I think it depends on what supposed to means, Ian.
Right.
I will
Well,
tell
I mean, in terms of working through the assignment and working through the questions, because then I have the spreadsheet, I have the information, but then I click on take the quiz, and that is a different set of information, right? So I don't have the spreadsheet that I've worked on previously that helps me or aid me with completing the quiz.
Got it. So with this, you have now created through the various Excel assignments a
Right.
spreadsheet that will accept all of this data, right? And it'll take this data and it'll spit out some really good outcomes and a rich body of outcomes. So if you put all this information in, including everything I've got up here in the upper parts and such, you can put all that in. But when you then open up the quiz, you see it gives you a couple of other pieces. Well, I would just go ahead and change the detail in the spreadsheets.
Mm-hmm.
And,
Okay.
which there's no problem in doing that. And yes, if you have input everything well into your spreadsheets, if you've been constructing your spreadsheets along the lines of what I've asked you to, then frankly, answering the questions on the homework assignment, the quiz part, is simply reading off from your outputs on your spreadsheet what the questions are asking. So remember me telling you that you guys want to do those, you want to build your model well, you would be using it in the future, it'll save you a lot of time. Here's one of the places going to save you a ton of time if you created it well.
Right. Okay.
And I structured this with a 5-year explicit period, specifically because your Excel spreadsheets are structured with a 5-year explicit period so that you could use that model you've put together somewhat easily.
Got it. Okay, perfect. Thank you. Appreciate you answering that.
No problem at all. Stevie or G, do you have any questions?
No, not right now.
Okay. Thank you, G. I see G says he's fine. So at the moment, I'm expecting that I'll be able to schedule a call for 9 o'clock on Sunday. It's conceivable I may have to push that to 9:30, but I'll let you know well in advance. And I'll send out a Zoom invitation, of course, for those that want to be on it. Yeah, there you go. Anything else that I can help you with before we clear off tonight?
thank you so much, Rick. Really
No,
appreciate you taking
absolutely.
the time.
Thanks, Graham.
That was helpful. Thank you.
Happy to
Appreciate
spend the time, guys. And you have a good evening, and I will talk with you in the next few days.
Thank
Okay,
you.
thanks. You as
Bye.
well.
Have a good night.
You bet. Bye-bye.